Hey everyone! Welcome back to the channel. Today we're diving into one of the most legendary books in investing history, The Intelligent Investor by Benjamin Graham. Even Warren Buffett calls it by far the best book on investing ever written. Whether you're brand new to investing or just looking for timeless wisdom, this summary will give you the key insights you need, all in under 15 minutes. Let's get into it. Benjamin Graham was a brilliant economist, investor, and teacher, often called the father of value investing. He taught Warren Buffett and helped shape modern investing. His book, The Intelligent Investor, isn't about quick wins or market hype, it's about smart, disciplined investing that can weather any storm. So, what does Graham mean by an intelligent investor? Spoiler, it has nothing to do with your IQ. An intelligent investor is someone who makes decisions based on logic, research, and long-term thinking, not emotion or market noise. Patience, discipline, and self-control are key. Graham says there are two main types of investors. 1. The defensive investor, someone who wants low effort, low risk. They focus on stable investments like high-quality bonds and reliable blue-chip stocks. Think, slow and steady wins the race. 2. The enterprising investor, more hands-on, willing to put in research and time. They look for undervalued stocks or special situations others might miss. Neither is better, it's about knowing yourself. Are you passive or active with your money? One of the book's most famous ideas is Mr. Market. Imagine the stock market as a moody business partner who offers to buy or sell your shares every day. Sometimes he's overly optimistic, other times he's depressed. Your job? Don't let his mood dictate your decisions. Instead of reacting emotionally, take advantage of his irrational behavior. When he offers you a great deal, buy. When he's demanding too much, sell or hold. The key? Stay rational. Next up, the margin of safety. This is like wearing a helmet while biking, a buffer to protect you from mistakes or bad luck. In investing, it means buying a stock below its true value. So even if something goes wrong, you have a cushion. It's the core of value investing, never overpay. Graham also breaks down the difference between stocks and bonds. Stocks are ownership in a company. Higher potential reward, but also more risk. Bonds are loans to a company or government. More stable, but lower returns. An intelligent investor balances both, adjusting based on market conditions and personal risk tolerance. For beginners, Graham recommends starting with 50-50 and adjusting slowly. Wondering how to pick a stock? Graham suggests looking at the company's earnings history, financial health, like debt levels, consistency and stability, valuation metrics like the price-to-earnings (PE) ratio. But remember, don't chase trends. Focus on business fundamentals, not hype. One of Graham's biggest warnings is about speculation, basically, gambling in the market. He says it's fine to speculate, but only if you know you're doing it. The problem? Most people think they're investing, when they're actually just betting on hype. Real investing is about safety, income, and long-term growth. If you are buying something just because it's trending, that's not investing, that's guessing. Graham's ultimate message is simple. The market will always fluctuate, but your behavior doesn't have to. Stay rational, ignore the crowd, and think like a business owner, not a gambler. Consistency beats brilliance in the long run. And that's a wrap on The Intelligent Investor. To recap, be patient, buy with a margin of safety, avoid emotional decisions, and invest for the long term. This book isn't about getting rich quick, it's about getting rich slow and staying rich. If you found this helpful, give it a like, subscribe for more book summaries.